My name is Dr. Samuel Mwako. I am the facilitator for commodity risk management that is falling under due diligence. So we'll look at various risk aspects that affect the commodity industry. In the first place, looking at the types of commodities that we can be talking about. So we went through to know that we have the soft, we have the metal, and we have the energy aspect. So our concentration was on energy, precisely oil and gas, that we look at it. So we try to identify some of the risks and how those risks could be mitigated. And some of the mitigation strategies, we have some are financial instruments and some are not financial instruments. So we look at the non-financial instrument as having a strategic risk, price risk management, having a strategic risk management as well. You're having a pooling where you can have, producers coming together to have a storage facility to be able to take advantage of price hike. We also look at the other financial instrument like the forward agreement, the forward contract, the money market instrument as well. We look at the swaps, options, and then we also look at how futures are traded in terms of what you call the margin requirement and then the market to market basis. And so we look at those things, and we also look at how we can apply value at risk to determine or quantify risk and to know how we have to mitigate. We also look at using sensitivity analysis in the risk profile. And then we also talk about using other statistical methods in doing that, like portfolio, to be able to do that and identify each variables and their risk component and the impact. So you could manage, because you cannot take all risk and start managing it from one point. So you have to look at it in terms of their impact and their occurrences. So we went through that, and then we also looked at how to use real options in terms of option application in valuing a business respectively in terms of the risk aspect, because we want to know that if there's a fall in the value of the business, that is going to affect the business, and that will be a risk that they have to manage. So the application of the option pricing model was also applied on some of the oil and gas cases, and to see what they have to do and how they should be mitigated in terms of the developed reserves and then the undeveloped reserves. So basically we look at that, and we also use the option pricing theory to also look at in terms of capital structure, that is the financing structure, to know if there's a fall in the value of the equity, what happens to the bond aspect. So that places a risk, because when your bond is increasing, then it means, or your debt is increasing, that means that here your gearing is becoming high, and then the shareholders are at receiving end, and therefore we must know how we're also going to manage that. So basically, that is what we did on the commodity risk management aspect. Now, today we look at financial modeling, because we wanted to look at how we can apply some financial matrices to be able to determine the viability of a project. So that's what we tried doing today, and today we went through the basic application of Excel, how to be able to code a date, how to code a month or year, and how to be able to determine the inflationary trend of whatever I do. Then from there, we want to look at how you can link the various layers and sheets together in terms of cascading those various sheets that you have, and then linking them to be able to produce a report. So you don't need to really be typing them one by one or wasting time, because the benefit of doing this or doing a model is to be able to work on projects very fast and also to be efficient in the use of time and also other resources. Because when you model your whole project, you were able to take advantage of the flexibility, because if there's any ups and downs, you are able to quickly go back to your data and to also be able to do the what if on what really is happening. So when you do that, then you can still keep your project in line. So you don't need to wait for project to take a dive turn before you come back to it. No, because within the model, you'll be able to identify what is going wrong within the model, and then you can take a corrective measures to correct that before it dive down. And so that is what we did today, and I think today was also very interactive, because the participants were very, very appreciative, and then the cooperation, because the approach that we used was not a talk show, but rather everybody by his laptop, and then inputting and also checking their formula bars and those things. So I think it was very interactive today, and I think it was a good